Hey, welcome back to part two of Year-End Tax Planning 2025. So for part two, we're going to continue with the new 2025 Form 1040 calculator, but we're going to explore a unique early retirement case study to see other variables impacted by the tax formula. Before we jump into the spreadsheet, let's introduce our family. So we have Maya, who's 56, and her husband Eli, who's 54. One important note on Maya's age here, 56. She retired last year at age 55, and she's considering using what's called the Rule of 55, potentially taking distributions from her traditional 401k even before age 59 and a half. So we're going to assume that Maya terminated employment in or after the year she turned 55. Next is her husband Eli, who also retired last year at age 53, and they have a son named Noel who's 16 years old and claimed as a dependent. Next, for their tax filing status, they'll be filing as married filing jointly. These next three lines are very important considering their health insurance and early retirement. This family currently lives in Florida, which has no state income tax, and they live in Hillsborough County, zip code 33604. This family is covered by a high deductible health plan through the health insurance marketplace, and they've noticed to be eligible for the premium tax credit, those health insurance subsidies, for the entire household to avoid Medicaid or CHIP. They're going to need modified adjusted gross income of at least $57,300 to receive that PTC. And we happen to be meeting with this family at the end of the year when they've already been covered by the Blue Cross Blue Shield Blue Select Bronze HSA plan through that marketplace. And they've been paying $337.58 per month after the premium tax credit. Before moving forward, let's look at those three variables and how they show up on the Health Insurance Marketplace website. We start at the website healthcare.gov/C-plans, where we can review the plan and prices based on where they live. One very important note as we get started, when I record this video, we're currently in open enrollment for the 2026 health plans. So since we're looking at the 2025 taxes, we need to look for the 2025 plans and prices. Let's go ahead and click that. Now we can type in their zip code of 33604, which is confirmed as Hillsborough County, Florida. Click continue. So in this household, it's you and other people. Let's assume that we're Maya filling this out. We continue. Yes, we're married. We will claim a dependent on the tax return. We're going to claim one dependent. That's Noel. So let's start with Maya. She's 56. And by the way, this is the age she'd be as of January 1st of the plan year. Female. And she's a legal parent or guardian of a child under 19, claimed as a tax dependent. We continue. And now moving to Eli, who's 54 as of the beginning of the year. Male. And also a legal parent or guardian of a child under 19. And lastly, we have Noel, who's 16 as of the beginning of the year, male, and none of these here. Continue. So we can quickly confirm the household members. We have Maya, who's 56, female, and a legal parent of a tax dependent. Then we have Eli, who's 54, male, also the same. And then dependent, 16, Noel, who's male. Confirm. So on the Word file, I said that the modified adjusted gross income need was at least $57,300 for the entire household to be PTC eligible. Let's go ahead and look at what would happen if we put a much lower number here. For example, $40,000. If we continue, we see that Noel, who's the dependent, age 16, would not be covered by those plans. We'd have to look into Medicaid and CHIP, specifically for Noel. But you see that Group 2, who are the parents, they are eligible for these plans, also with a significant premium tax credit. So let's back up and see how high we need to make this for the entire household to be covered by a single plan with a premium tax credit. So going back to view steps, I'm going to edit the household income, and I've already typed in these variables, and I previously continued to increase this until I got to $57,300 for 2025. So now when I click continue, with that level of modified adjusted gross income, the entire family is eligible for those plans and also the premium tax credit of $19.15 per month. By the way, if I multiply that by 12 months, that's $22,980. And as we'll see in a moment, without the premium tax credit, they could be looking at 20% of their annual budget just going to health insurance premiums before they even go to the doctor. So now that we've estimated the premium tax credit for modified adjusted gross income of $57,300, let's go ahead and view those plans. In this case, it was after the fact they've already been covered throughout the year. If we were in open enrollment or special enrollment, we might consider other plan options that they didn't consider before. But in this case, let's quickly filter to find that plan that they were covered by. So if we add filters here, We can simply go up to eligible for an HSA, which will eliminate most of the plan options. We apply the filters, and we see right here at the top, we can confirm this is their plan, the Florida Blue, Blue Cross Blue Shield, Blue Select Bronze plan with the HSA, and their premium after the premium tax credit is $337.58, which means they're paying $4,051 per year for those premiums. Before we go back to our Word file, let's look at these plans' unique details. We first see that without a premium tax credit, they would pay $2,253 per month for this plan, which would have cost over $27,000 for the year. Now to the right, they have a deductible for the family of $13,300, and just $100 more, their out-of-pocket maximum for the family is $13,400. Right below, we see some of the coverage details, including primary care, specialist care, urgent care, emergency room, outpatient mental health, and generic drugs. There are no small copay opportunities, and they'll have to reach their deductible before coinsurance kicks in, but only for the $100 difference. As soon as the family hits this out-of-pocket maximum, all of their care in-network would be 100% covered by the insurance provider. The family should also make note of the plan type, which in this case is EPO, Exclusive Provider Organization, versus HMO, PPO, or POS, and also ensure that any providers that they would like to work with are in that network. Moving back to the family details, we've explored the cost of the health insurance and also what modified adjusted gross income is needed to receive that full premium tax credit eligibility. So I'm going to go and highlight this number, $57,300, because this will become very important when we're calculating their year-end income sources. Running down the Form 1040, that federal income tax return, these are the income sources that show up so far. We have taxable interest from their checking and savings accounts of $6,000. We have qualified dividends of $7,000 from their taxable brokerage account, specifically is coming from the U.S. Total Stock Market Fund. Then we have a small amount of non-qualified dividends. And so far, year to date, they have net long-term capital gain of $3,000, which, like the qualified dividends, will receive the long-term capital gains tax treatment, possibly of 0%. Before we arrive at the line of AGI, we need to consider the above-the-line deductions. In this case, the family is making HSA contributions. We have $8,550 for the family HSA contribution, plus $1,000 for Maya, since she's 55 or older by the end of the year. Before we start implementing some opportunities, let's go ahead and add up the adjusted gross income. So taxable interest of $6,000, plus qualified dividends of $7,000, plus non-qualified dividends of $1,000, plus net long-term capital gain of $3,000, and then minus $9,550 for those HSA contributions. And by the way, those HSA contributions should show up on the federal income tax return on Form 8889, which flows to that Schedule 1 Part 2, which we'll see in a moment, for those adjustments to income. After that significant adjustment, we have adjusted gross income of only $7,450. And now with the above-the-line deduction of the standard deduction of $31,500, we see this as a missed opportunity so far that they have available space in the 0% tax bracket for ordinary income. So at least for now, we have ordinary taxable income of $0. That includes wiping out the long-term capital gain, giving us taxable income of 0, and of course total tax of 0 as well. With that said, we might also consider the refundable portion of the child tax credit, since their son Noel is under age 17 by the end of the year. So we see that missed opportunity with a significant standard deduction, but much more important, remind ourselves of the modified adjusted gross income level that they need to meet or exceed to start receiving that premium tax credit. Their modified adjusted gross income right now is only $74,550, which is a long way away from that $57,300. Before we jump into the spreadsheet, let's quickly look at their investment portfolio to discover where some of these opportunities might be found. This family has a total investment portfolio of $2.132 million, with a current asset allocation of 72% U.S. and foreign equity and 28% bonds and cash, which in this case will assume balances between their risk need, risk capacity, and risk tolerance. We break out the portfolio's tax location of taxable accounts, pre-tax accounts, and tax-free. Starting with the taxable accounts, we have bank accounts, checking and savings of $12,000 and $140,000. This family assumes they'll be living off of their savings account, at least for their first year or so of early retirement. Next, we have a taxable brokerage account of $600,000. It's 100% invested in stock in that total U.S. stock market fund, VTI, with an unrealized capital gain of $250,000. If we divide the $250,000 of unrealized capital gain into the total value of $600,000, that gives us a tax impact score of 41.7%. Although we might have opportunities to sell specific lots using specific identification, spec ID, All we have here is the average cost basis information to start. We'd want to dive into that investment account in more detail to be more specific, but at least for now, we can assume that for every $100 of VTI that they sell, $41.70 of that will be included in gross income, most likely as a long-term capital gain in this case. So their total taxable balance of checking, savings, and taxable brokerage is $752,000, which is really going to provide some significant flexibility moving forward, especially for early retirees. Next, we have our simple pre-tax accounts. We have Maya's traditional 401k from her previous employer. Current balance is $700,000. That's invested 60% equity, 40% fixed income. And as I mentioned before, she's considering the rule of 55, keeping her 401k where it is, just in case she needs to tap into this account between now and ages 59 and a half. Keep in mind that if she rolled this 401k to an IRA, she would no longer qualify for that rule of 55 to avoid that 10% early withdrawal penalty. She would have to consider other options, such as a 72T plan, also known as substantially equal periodic payments, or another penalty exception. Also keep in mind that if Maya does take a 401k distribution, there will be a 20% mandatory federal income tax withholding on that amount, which could be much higher than necessary considering her effective average tax rate. Then we have Eli's traditional IRA. Since he retired in his early 50s, he already rolled his 401k into his traditional IRA for more flexibility, including potential Roth conversions. So combining Maya's 401k with Eli's traditional IRA, we have a total pre-tax balance of $1.1 million. Now we move to the tax-free accounts, starting with Maya's Roth IRA of $100,000. That's invested 100% equity. Eli's Roth IRA is also at $100,000 and also invested for long-term tax-free growth at 100% equity. We have Maya's health savings account of $40,000, also aggressively invested. And lastly, Eli's HSA, which is also at $40,000, invested at 100% equity. So the total tax-free balance is $280,000. One thing to keep in mind is although Maya and Eli are considering these as the last spend assets, there could be tactical opportunities in retirement to take tax-free distributions and reimbursements from these accounts to avoid spiking their income into higher brackets or losing out on eligibility for other benefits. For now, they assume they're not going to touch these accounts until decades later. And lastly, but very importantly, their living expenses after tax are $120,000 per year plus the health insurance premiums. If we're able to help this family raise their modified adjusted gross income so they keep those significant premium tax credits, their total after-tax living expenses will be about $124,000, which divided into their current investment portfolio, that's a 5.8% withdrawal rate. Although 5.8% might sound high, also consider the future Social Security coming in the next decade or so. Assuming they're diversified based on their current living expenses, the analysis would most likely tell us that they have sufficient assets to remain fully early retired. So now let's take all these numbers from before and put them into our 1040 spreadsheet to find unique opportunities. Before we start plugging in the numbers, remember we have to select the filing status, in this case, married filing jointly, and no taxpayers age 65 or older. Moving down the first page of the 1040, there are no W-2 wages. We get to taxable interest, which was $6,000. We had qualified dividends of $7,000, non-qualified dividends of $1,000, which the $7,000 plus $1,000 gives us total dividends of $8,000. So far, we don't have any IRA distributions, Roth conversions, or taxable pensions, annuities, or workplace retirement plan distributions. They are not claiming Social Security retirement benefits yet, and we had a long-term capital gain of $3,000. Those added up gave us total income of $17,000, but we must also include those adjustments to income on Schedule 1, Part 2. Part 2, which is on the right side here, includes the health savings account deduction from Form 8889. So we'll enter that amount, which is the family contribution of $8,550, but also the catch-up contribution for Maya since she's age 55 plus, so $9,550. So we step back to the Form 1040, and we see here, confirming our math, the adjusted gross income is $7,450, which is below the significant standard deduction of $31,500 for that ordinary income. One thing you'll note on this calculator for this example is up here in column J, modified adjusted gross income for those ACA premium tax credits. So currently their modified adjusted gross income is $7,450, but we need to raise that level intentionally to $57,300. Since this calculator is fully unlocked, you can customize it however you'd like. So for this example, let's go ahead and add the desired modified adjusted gross income level for those premium tax credits. So the desired level is $57,300. Let's go ahead and put that in a box, and we'll call that desired MAGI for ACA. And then now to the box over here, let's do equals that desired minus the current to give us how much more income we'd have to add to receive that premium tax credit. So we need to add income of $49,850 to get them up to that modified adjusted gross income level to receive the full premium tax credits for the entire household. Otherwise, they'd fall below that into the Medicaid area. So we can scroll back over here and think, what are some opportunities that are available to us that could help us increase our income on purpose to receive that full premium tax credit? I would first start by going down here to say they have this significant standard deduction of $31,500, which if we had the choice, we would prefer that standard deduction to wipe out ordinary income versus long-term capital gains income, since ordinary income does not receive those favorable tax rates like qualified dividends and long-term capital gains. In this case study example, let's assume that Maya's traditional 401k plan, she's reviewed the summary plan description, that SPD, and they do not allow in-plan Roth conversions for terminated employees, and they also don't allow partial rollovers to other qualified plans. So what we might consider is Eli's traditional IRA of $400,000. Maybe we add an intentional quote-unquote taxable Roth conversion, and to calculate the starting point for the Roth conversion, let's figure out how much of the adjusted gross income AGI is coming from ordinary income versus long-term capital gains. Our ordinary income sources right now are taxable interest of $6,000, the non-qualified dividends, that combined gives us $7,000, but we also can't ignore that adjustment to income of $9,550, which can also wipe out the ordinary income. So our ordinary gross income right now is technically negative $2,550. Now we subtract the standard deduction, which is $31,500, and that tells us that the Roth conversion amount we could do is $34,050. To confirm what we just did, that Roth conversion of $34,050 now takes total income to $51,050 minus the HSA contribution of $9,550, giving us adjusted gross income of $41,500 minus the standard deduction of $31,500. That gives us taxable income of $10,000. But remember, taxable income is split into ordinary taxable income and long-term capital gains taxable income. So the entire taxable income right now is made up from only the long-term capital gains taxable income, which is the qualified dividends of $7,000 plus the net long-term capital gain of $3,000. What's amazing here so far is that ordinary taxable income of zero is taxed, of course, at 0%, saying that entire Roth conversion of $34,050 plus the taxable interest plus the non-qualified dividends were all taxed at 0%. And if we think about Eli's traditional IRA, he deferred gross income into that previous traditional 401k, possibly at the 22, 24, 32% brackets, and now he's converting it at 0% federally. That's incredible. He somehow made a traditional retirement account triple tax advantage, similar to an HSA. Now that we've knocked out the standard deduction of $31,500, let's scroll over here to look at where our modified adjusted gross income sits right now. So it's currently at $41,500, but remember, we want to bring it up to $57,300. So now we need to add additional income of $15,800. We could add additional Roth conversions of $15,800, which at the 10% marginal tax rate would only be a federal income tax of $1,580. And alternatively, we could do what's called tax gain harvesting, which is selling some taxable brokerage assets that are appreciated, but realizing that capital gain at the 0% long-term capital gains tax rate. And again, that's called tax gain harvesting, which is different from tax loss harvesting, which we saw in our previous case study. For this case study example, let's say that we do want to take advantage of tax gain harvesting while also getting our income high enough to receive the full premium tax credit. If we need additional income of $15,800, what we can do is divide that additional income that we want of $15,800 and then divide that into the current tax impact score of 41.7%. Assuming average cost basis without going into specifics here, this calculation is telling us we might sell $37,890 of this VTI to add an additional realized capital gain of $15,800. Again, the $37,890 times 41.7% equals $15,800. You might be wondering, what do they do with this $38,000 that settles from selling VTI? One thing this family could do, if they wanted, is immediately repurchase VTI with a new higher cost basis. And there are no wash sale rules to consider because they sold at a gain, not a realized capital loss. Moving back to the spreadsheet, let's go ahead and add that long-term capital gain that we added of $15,800 to the pre-existing long-term capital gain of $3,000. So that would be $18,800 for the total long-term capital gain. So we can see now our modified adjusted gross income for the premium tax credits is $57,300, which is exactly what we desired to receive those full premium tax credits. As we move through the Form 1040 now, our total income of $66,850, we reduce that by the HSA contributions of $95.50, which gives us adjusted gross income of $57,300, which in this case is the same as modified adjusted gross income. We have the standard deduction of $31,500, which wipes out the entire ordinary income. So now we're left with taxable income of $25,800. And since it's all long-term capital gains taxable income, this all falls within the 0% long-term capital gains tax bracket for a married couple filing jointly. If you're wondering, just for reference, in 2025, for married filing jointly, that's taxable income up to $96,700. This long-term capital gains taxable income is taxed based on the combined taxable income, including the ordinary income, when considering those calculations. What's fascinating about this case study is we have total tax of $0, but by intentionally adding gross income, they're going to receive the full $1,915 a month toward their health insurance premiums, which again, annualized is $22,980. One note I want to make that goes beyond the scope of our calculations today is also consider their tax dependent Noel, who could be eligible for a child tax credit, which has both a non-refundable and a refundable portion. So they could weigh the trade-offs of adding even more ordinary income, for example, more Roth conversions, that are still taxed at 0% due to those tax credits for Noel. But keep in mind that those tax credits would not reduce the modified adjusted gross income for ACA. You'll have to weigh the trade-off of receiving the tax credit versus losing a portion of that premium tax credit. Moving back to the Word file, let's assume they did that Roth conversion from Eli's traditional IRA of $34,050. This year's Roth conversion was focused on the premium tax credit. This Roth conversion only represents about 1.6% of their total portfolio. We might consider doing more aggressive Roth conversions, but probably not until Maya and Eli are closer to those golden years of when Medicare eligibility starts at 65 and going through age 70, when Social Security benefits can be delayed. And my last note is that we should also consider their son Noel and how they might intentionally control income to receive significant financial aid if he's attending college soon. Some clients I work with have similar portfolios of over $2 million, but because they can keep their gross income low, sometimes their students receive full financial aid, especially for in-state tuition, depending on their state. So just be careful not to get too excited about aggressive Roth conversions when there's a lot of benefit eligibility to consider. I hope you've enjoyed this case study recording as much as I do, and I look forward to our next conversation. Measure twice and keep finance personal.